Hi, I'm Jim Jubak, and welcome to my live Q&A video. Shooting this on Tuesday, March 21st, which is the day before the Fed meeting. So I've got my crystal ball. So I'm going to do my fearless prediction. Tomorrow the Fed meets, the Fed's Open Market Committee, to set interest rates. A month ago, the bet was on 50 basis points increase. Then we had the banking crisis. Recently, the bet has been on 0 to 25. I think the Fed is going to do 25 basis points, mostly just to keep its hand in the game and say, we're still worried about inflation, even though we're worried about the banking system more at this point. Okay, so that's what I think we're going to do tomorrow. And now we're going to answer some questions that people have sent in ahead of time. And you can, of course, send in a question now. What do we got, Katie?
All right, this question's
This is Katie.
Hello, I'm off screen. This question's from Mike. He says, what is the next Nvidia? A company that with a creative plan that will return 11,000%. You brought Nvidia, that's the ticker, to my attention during 2007, and I was well rewarded.
Okay, can we show the Nvidia chart?
Yes, we can. Let's bring that up. And
No, wrong one.
there she is.
Okay, so this is a recent chart, and as you can see, it's very volatile. One of the things is, I would love to be able to jump in my time machine and go back and do that. One of the things to realize is if we're trying to duplicate a Nvidia-like return is how unusual the Nvidia story is. That one of the things that happens a lot these days to promising technology and growth companies is they get acquired. They get rolled into a Microsoft or a Google or a Amazon, and or a chip company, and they therefore never get the long run. One of the things that made Nvidia so profitable was the fact that it came out of nowhere. Not in the sense that it was a nowhere company, but it was a company that made GPU processors for video games. And no one really knew that what was going to happen to the underlying technology world is that the massively parallel processing that you needed to run computer graphics was going to become very, very valuable for things like the internet, for artificial intelligence. So in some sense, Nvidia was tooling along as a pretty good computer game company. They were gaining share, but then the market shifted underneath, and all of a sudden this big opportunity opened up that they hadn't expected, that no one expected, and that's why the stock went through the roof, and that's why Nvidia is still a good buy, because we're still seeing those markets open up for the company. So looking forward, what would you say? I don't think there's any way to predict what you're looking at. If you look at things that might trend, I really like electric bikes. For example, Shimano, which makes the gearing system for non-electric bikes. The electric bike market is now larger than the market for electric vehicles. Shimano could do that. QuantumScape, which is trying to do a solid-state lithium battery. But one that I like even more is ESS Technology. Symbol is GWH. And they make iron flow large storage batteries for utility scale battery storage. You wouldn't put these in a car, but if you had a stationary utility, you would. This is a market that I think is going to explode. The stock is really cheap right now, so that might be one to look at. Okay, next question, Katie.
Next question is from John. How safe are preferreds of First Republic? What about other banks like SNV?
Well, the whole idea of a preferred stock is that it gets seniority, if you will. That as a bank if a bank gets in trouble and has to be wind down, its paper goes to zero in a sort of progressive order. So one of the big hoo-has about the way that Credit Suisse has been folded into UBS is that the Swiss regulators violated that order, that there was that equity should be wiped out before a round of bonds, a level of bonds known as COCOs, AT1, and they weren't. The COCOs went to zero first. So if you're looking at preferred or really high up, a bank would have to be insolvent for the preferred to get wiped out, because if all the equity owners get wiped out, the preferred owners would too. If it's a deal that's less drastic than that, they wouldn't go to zero. I think your question though really is, are they going to go down? And I think that preferreds get preference in dividend. They've got more safety. I think they're less likely to follow the exact path of the common equity, but I would really worry about regional banks on a one-to-one basis and look at each one. A lot of them are bought for dividends, and that's one thing that if you get a capital crunch is going to go first. So other than just saying, be careful. Okay, next.
Next, this is from Chris. Is there a risk of the Fed raising their interest rate above 6%? If so, how high could it go realistically?
If you're a non-political economist and you're simply looking at the numbers and things like the Taylor rule, which looks at unemployment and interest rates, the Fed should raise rates to somewhere like 7 to 8% to get inflation under control by the numbers. But the Fed does have a lot of economists working there, but they are not apolitical economists. They understand politics. There was a great 19th century political humorist, and his character was Mr. Dooley. And one of the things he said about the Supreme Court in that case and was that the Supreme Court follows the election results. You can say the same thing about the Fed, that the Fed does not want to crash the economy and wind up with a recession or worse on its historical record. So I think in terms of getting inflation under control, my take is that the Fed is not going to get inflation under control in this round. That the Fed may raise rates as high as 6%, maybe a little tad above it, and then the Fed is going to pull out some economics magic and say, hey, the labor market has changed significantly, and so we really don't need to move to the same kind. A 2% rate of inflation is an artifact of an old economy. We don't need to go there. So maybe a neutral rate would be more like 4% inflation, and therefore we're only going to raise rates up to 6, and then we'll just call it a victory. That's my guess. So I would say 6 to 6.5 is probably the top for this cycle. The problem is that if the Fed does raise to 6, declare victory, and inflation doesn't cooperate, which I don't think it will, then the Fed has got to go back at some point and revisit this all over again, at which point we're starting from inflation at 5% instead of inflation at 3%, and it'll make it harder to get under control. And therefore, the second round, if we have to do one sometime after, say, 2024, which happens to be an election year, would be much more strict. We got another one?
Yep. This is from Paul. Would you talk about NJDC, ticker NIDEC, and your thoughts about how it has dropped so much and your advice on selling or holding?
Okay, so we've got a chart. Okay, this is Nidec. It's a Japanese company that makes electric motors. And one of the things the company has done is said, hey, everybody's building things with electric motors. We're going to go into this business. We're going to get market share in China. We're going to get market share in Europe. We're going to create electric drivetrains for third-party manufacturers, etc. They're doing that. There are two problems with that. One is it's a long-term effort. So right now, they're not seeing much in the way of profitability from that business, and that's the growing part of the business. The non-growing part of the business is motors for things like hard disk drives, spin motors, and demand there has been plunging. So when you see the stock go down like this, what you're really looking at is the fact that you need to put this in the context of a Japanese company. Japanese companies play really long games. It is both their advantage to an investor and a curse. Curse because you have to really be committed to the long term along with the company. They have done a management shakeup. They're not happy with how things are going. They have built a 9% market share among Chinese manufacturers of electric vehicles. That's really great. More growth to come. But I think profitability is a long way off. If you want to play this for the long term, you got to basically say, I am turning Japanese only more so, and be a long-term investor and not worry about the short-term stuff. So if you're going to hold this, ignore the chart for a year or two, because that's not where the game is.
Those are the questions we have.
We got anybody else coming in?
Let's see. See if anybody has questions on live chat. I don't see any questions right now.
Okay, well, I'll stop staring into the screen like that, and talk about what worries. Well, two things. One is what over the short term I think is a really interesting observation. This comes from Dan Ives of Wedbush. He's their technology analyst. He's been a technology analyst for years and years and years, and one of the best. But one of the things he said about the banking crisis is, well, hey, we're about to go into earnings season, and bank earnings are going to be not only not that great, but they're also going to be full of statements of uncertainty. And people are going to be looking in this environment, because it's not going to be a great quarter for earnings. They're going to be looking for companies with solid, predictable earnings growth, and maybe this is an advantage for big technology stocks. This was, the question I would have about this is how long this effect would go on. But certainly, if you're looking at, say, an Apple or a Microsoft, companies that report around the 25th or 26th of April, this might be a time when they're going to look very attractive and their earnings are going to look relatively strong. So this might be a time over the next month for a shift in sector strength, and technology companies of that size are going to lead the market. But you need to be very careful, because while that is going on at predictable technology companies like Apple and Microsoft, you've got Amazon going out and announcing another 9,000 layoffs. So it's by no means clear sailing for technology stocks either.
All right, we got some chats coming in.
Oh, okay.
Sounds like we're having some audio problems.
We're having some audio problems?
Yeah. Let me just
The audio is horrible. Is there any way to improve it?
I'm trying. Okay.
We hope that's better. Okay, someone asked, Morris asked, what do I think of WFC and BAC? This is Wells Fargo and Bank of America. So let's take the banking crisis out of the equation for the moment. I don't like Wells Fargo, because I think it's been a historically, like the last 5 years, very badly run bank, bad controls. And I wouldn't like to be invested in any bank that has a history of bad controls, and we're going to an environment where things are really flaky. On the other hand, huge bank, probably not exposed to the same risks, certainly not exposed to the same risks as regional banks. If I was picking one of those two, I'd certainly look at Bank of America instead, better run. And if I was worried about sort of like safety, the gorilla in this market for banks is J.P. Morgan, and which is indeed too big to fail. So if you're looking for a place to stash some safe cash, I would look there. Bank of America has also been getting cash from depositors who are fleeing smaller regional banks. So I don't know that I want to take on the extra risk of owning Wells Fargo, but Bank of America, yeah, I would. What else we got? Voice quality poor, looks like we're getting better. Okay, so the other thing here that I wanted to talk about was, and I'll be doing a canned video on this today, is we're starting to hear conversations about an impending Minsky moment. And for those of you who, Chaim Minsky was an economist, died in 1996, a student of, well, he came out of the Chicago School of Economics, so that tells you a lot about his focus on monetary policy. But one of the things he was interested in was the way in which sort of credit cycles work. And one of the things he noted was that when an economy is going good, banks have cash to lend, they want to lend, they're looking for more and more opportunities, they tend to cut their credit standards to keep their cash going out the door, which is what we're seeing now. What we're seeing really is basically a situation where banks have been taking on more risks than probably was prudent. What Minsky's observation is that's sort of a self-correcting process but it then corrects to the overside, which is that as banks get into trouble, they decide, oh my goodness, our credit quality was declining, we're now going to tighten up, and they tighten their credit standards and they basically stop lending. And that gives you a Minsky moment where the problem is in the past, but the problem in the past has created the problem going forward, and then you get a crash in bank lending, and that's what people are starting to worry about right now. If I were to look around and go where there might be a danger, the place that the IMF, the International Monetary Fund, has pointed its finger at is in low-income developing countries that basically said, hey, 50% of the debt issued by those countries is what we call distressed. And the big lender there, China, has basically said, hey, we're not going to throw any more money into these countries. The U.S. is not picking up the slack. No one's picking up the slack. So the question is really what happens in these markets if we do indeed get a continued credit contraction. Okay, now we've got one from Roger, who says, holding 40% in cash, have some good positions that are down now, recharacterizing to Roths and keeping under the 22% tax rate. Do you still see a strong leg down this summer? I'm not sure it's this summer. My worry is more near term than that. The catalyst that I see, the things that worry me right now is that we're looking at the consensus forecast is for 2 quarters of negative earnings growth, the first quarter and the second quarter. So basically you're looking at companies doing a lot of coming out and saying, hey, we're still seeing cost pressures, margins are collapsing. So that's pressure on the downward market. The big outlying question, of course, besides the Fed, and the Fed is just sitting there, is what's going to happen with the debt ceiling? Is this going to be pushed to a crisis? I think there's a good likelihood that we're going to walk the plank further out than we have in the past. Whether we actually plunge into the shark-infested waters is another question. I don't know that. My hope is not. My fear is that we will do something stupid. So if I'm worrying about something, the worry really is sort of in the June timeframe. Right now, the reason this market is holding up so well is because people are saying, hey, but the third quarter and the fourth quarter look much better, and the forecasts right now are for positive earnings growth of 7-9% in those 2 quarters. So I'm going to hold until I get to those, and I'll not worry about this stuff right now. What I would be doing right now is looking for companies which don't look like they're going to be able to make the transition because again, cash flow problems. I would look for companies that are having trouble raising money. So some younger companies, and those companies I would take out of my portfolio right now. I would sell them. Not so much because I need to own more cash. If you own 40% cash, I think your cash needs are covered. But I'm looking to build up a cash portfolio so that if indeed you do get some kind of event in the June, July timeframe, I have money to put to work then. Because I think the economy is the U.S. economy is still basically a strong economy with growth going forward. So I'd like to continue that rather than sit in cash until the cows come home. What do I think about Bitcoin? I think if you have some way of understanding who a trustworthy, transparent, reliable Bitcoin market is, then play Bitcoin. I don't think there is a way to tell that. I think it's very clear that some of the players in this market are not everything they should be, and I don't know that people are going to get what they expect. So the problem really is, if you think about whether you like regulation or not, one of the things that the regulation provides to the financial system is a certain degree of transparency. We have that in bank and a certain degree of transparency before I get hammered by saying, well, it's not transparent. I know it's not transparent. The accounting rules suck. But it's better than an unregulated situation. If you can imagine what the banking system would be if we didn't even have ineffective regulators. Well, Bitcoin is largely unregulated. We don't know who's playing. We don't know who's playing with what. And it's not a market that I feel comfortable recommending to people for that reason.
Still having sound trouble.
We're still having sound problems. We
Might be your
apologize.
connection. I think it's probably the connection.
You think it's probably the connection? Our connection here at this end? We're being slow? Okay. So maybe given the sound problems, we're just going to call this to a halt and not torture you and us any further. And we'll try to figure this out and do another one very, very soon with better sound. Okay, thanks for suffering through it with us. And we'll try to do better next time, and we'll do it very soon next time. So look for a new notification, and I'll try to put a little notice there that says, better sound.